Right, today on Talk About Rate Cuts, Trade Policy, and the Dollar, what lies ahead for global currencies. Okay, it's an important discussion. So let's dive in. Now, since the start of the year, several major central banks, including the Federal Reserve, the European Central Bank, Bank of England, and Bank of Japan, Reserve Bank of Australia, and Reserve Bank of New Zealand, have already announced their interest rate decisions. Now, as we move into March, right, attention will shift to the upcoming rate decisions from the ECB, Swiss National Bank, and Bank of Canada. Now, early indicators suggest that all three, European Central Bank, the Swiss National Bank, and the Bank of Canada, are likely to implement further rate cuts, reinforcing a trend towards monetary easing. So if these cuts materialize, it will leave the Federal Reserve and the Bank of England with the highest interest rates among the major global economies, while the Eurozone and Canada would have some of the lowest rates, right? So this divergence in monetary policy could create a significant impact on the currency market, particularly for the euro and the Canadian dollar, which may face increased downward pressure due to widening interest rate differentials. However, right, geopolitical developments could temporarily shift market dynamics. In the short term, the potential for a ceasefire agreement between the US and Russia over the Ukraine conflict could provide a boost to risk sentiment. Now, this in turn may strengthen the euro, British pound, Australian dollar, New Zealand dollar, and Canadian dollar, all which have demonstrated resilience against the US dollar in recent weeks. So, the easing of concerns surrounding US tariffs threat has also contributed to this broad-based relief rally, right? So despite this current bout of US dollar weakness, it would be premature to assume it is a lasting trend. Why do I say that? Because several key deadlines for tariff implementations loom on the horizon. Now, first of all, on March 4th, the 25% tariffs on Mexican and Canadian goods under the International Emergency Economic Power Act, IEEPA, are set to take effect, followed closely by the March 12th deadline for 25% tariffs on steel and aluminum imports under Section 232. Now, not to forget, on April the 1st, the risk of a sharp policy shift remains, as President Trump is expected to announce reciprocal tariffs on numerous trading partners. Now, this move could signal the beginning of a broader campaign against a global trade system he argues is unfairly tilted against the US, potentially escalating tensions and disrupting international markets. So if these tariffs are enforced, they could trigger a global trade war, dampening economic growth and ultimately reinforcing demand for safe haven currencies such as the Japanese yen and the US dollars. Okay, so have a look at the chart right over here. This is the daily chart of the dollar index. So my expectation from the longer term chart technical perspective, the US dollar index appears poised for further downside in the near term. Okay, so expect it to come down more first. Now, decline towards the 106.1 level is likely, which we are already seeing that happening, with a potential consolidation phase before further losses take the index down to 104.9 or even 104.5. Now, this is the 50% area in based on the Fibonacci, measurements right over here. Now, however, should these levels be reached around April, right, coinciding with renewed tariff-related uncertainties and shifting monetary policy expectations, the US dollar could regain strength, reversing its recent downtrend trajectory. Now, whether this is going to take off this high, we need to see first, because at the end of the day, we need to look at Trump's tariffs in detail. How exactly would it affect the global economics? Okay, the global economy. And from there, we will have a better idea whether or not the US dollar index, right, could break this high, or this is just a retracement for another move down. Okay, because why do I say that? Number one, now based on the bigger time frame, this entirely is already a complete corrective structure. That means when I say complete, means the US dollar index doesn't need to break this high to start coming down. And as you all know, Donald Trump, right, he actually favors a weaker US dollar, which would benefit the US in general based on his economic policies. But he has to face one particular thing, which is inflation. Now, inflation continues to rear its ugly head, right? The Fed would not cut rates. And if the Fed refuses to trim its rates, then the US will continue to have higher interest rates than the rest. And the buyers will still be queuing towards, will be looking towards buying the US dollars instead. So that's the difference between whether this is going to make a new high or this is the high for the US dollars index to come down. But nevertheless, like I said, first, this is my expectation, either this level or this level before that correction, and we will decide this particular correction. And notice that this is a daily chart, so this is not going to happen overnight. Probably it will take some time. We may need to wait for a month to have an idea how this is going to play out. Okay, so with that, that's a report for today.